Hello and welcome back to FX Trading course. After topic 1 and 2 of chapter 6, you would have comprehended the theory and practiced the FX futures trading operation. The third topic is about the pros and cons of future contract. In this topic, we will analyze and discuss the strong and weak points of futures trading. This will help you understand why futures is popular among investors and speculators. First, let's talk about the good points. The first strength of futures is protection against price fluctuations. The feature of determining the trading rate at contract date and delivering in the future helps investors fix the profit and cost regardless of the exchange rate fluctuations. This is the same as forwards contract. The second attraction is the openness to investors, which comes from the size character. Future contract size is standardized and relatively small. For instance, the Australian dollar futures contract size is 100,000, British pound is 62,500. This gives small and individual investors chances to participate in futures markets. The next benefit is its financial leverage nature. The execution cost of futures contracts is negligible. Usually, investors don't have to pay the whole contract value. They solely initiate and maintain a margin about 5 to 10% of contract value. This benefit is also stemmed from the next convenience. That is the easiness of closing positions. Investors could close their position at any time simply by trading owned contracts with the clearinghouse. This is futures' exclusive asset. The last advantageousness is transparency. Futures transactions are done on centralized exchange. That information about regulation, prices, etc. is publicized and applied to all participants. Next, let us point out the disadvantages of futures contracts. Its standardization in currency, expiration date, contract size, makes it less flexible to meet investors' various demands. Although most of major currencies can be traded on the exchange, other less common currencies cannot be traded. The expiration date is also predetermined on some specific dates of the year. For example, on CME, futures contract expiration date would be on Wednesday of the third week of March, or June, or September, or December, in spite of investors' demand. This is so much inconvenient comparing to forwards, which parties can negotiate regard their needs. Small and fixed size of the contracts, which is the strong point, is also a weak point. Imagine an investor needs 250,000 Australian dollars. He has to buy 2 futures Australian dollar contracts and buy the rest 50,000 in other markets. Or should he buy 3 futures contracts, he has to find a way to sell the extra 50,000. This is when the standardization of futures got inappropriate. The last one is its irrevocableness. Similar to spots, forwards, and swaps, futures contract is immutable. Once the contract is signed, it must be carried out. This downside could be hedged using options, which we will look at in next chapter. We have learned about the pros and cons of futures currency trading. Next, we will study its applications in foreign exchange market in practice. 2 common applications of futures are risk management tool and speculative tool. Let us start with futures as a risk management tool. The features that make it a risk management tool are: 1. Trading price or rate is determined on sign date. 2. Expiration date or delivery date is in the future. 3. It's an irrevocable agreement. Therefore, those who need buying or selling foreign currencies can use futures contract to fix the cost or profit, without concerning price fluctuations. This is the same as forward transaction, which we have studied in previous chapter. The second use of futures, which is most popular, is as a foreign currency speculative tool. This popularity comes from two characteristics. First is low execution cost. Only with an initial margin at 10% or less of contract value, investors could take part in the trade. This financial leverage trade is attractive to speculators. Second is the availability of closing position whenever needed. Investors could take profits or stop losses anytime through trading their contracts with the clearinghouse. Let us take an example to have better understanding of this application of futures. Knowing today Euro spot's price is $1.1540, investor guesses it will rise to $1.1595. What should he do to make a profit? He could come up with three plans as follow. Plan A: buy Euro spots then sell after a month, expecting the price would rise. Plan B: buy 1 month Euro forwards at a price lower than the guess price, $1.1550 for instance. When receiving Euro next month, if the price increases as expected, he would sell it. Plan C: buy Euro futures at $1.1540. When the price reaches expectation in the future, he would settle the futures contract. Let us analyze each plan to find which one is the most profitable. Plan A: using spots contract. This plan's prerequisite is the money available at hand. It requires an amount of USD equivalent to the amount of Euro traded at spots price. For example, if an investor wants to buy 1 million euros, he must be holding the amount of USD equals to 1 million multiplied by 1.1540. That is $1,154,000. It's quite a number that not many can have in possession. This is Plan A's first hindrance. Suppose that the investor has enough USD to buy 1 million euros. If the price of Euro won't meet his expectation, or worse, it falls, then he will suffer losses. Plan A appears too costly and risky. Plan B: using forwards contract. This plan doesn't need huge fund at the beginning. Only a negotiable amount of deposit is needed initially. However, by contract due date, still, the investor be in need of that much of USD for payment. And he too has to bear the risk of unfavorable price changing. Plan C: using futures contract. This plan's huge advantage is low initial cost, the initial deposit. In 1 month, should the price satisfy the investor's desire, he could close position and take profits through selling the contract to the clearinghouse. Otherwise, should he find the price changes unexpectedly, he could stop losses also through closing long position. The profits or losses equal to the contract size multiplied by the difference between the contract price and the price at position closing time. So, without much cost needed throughout the process, and the flexibility of changing positions, futures contracts help investors avert considerable uncertainties. Through above illustration, you could imagine how futures trading is used in the FX market. In fact, it is favorable to either small and individual investors or large investment funds because its financial leverage attribute could help make decent profits with minimal initial cost. Statistics show that most of futures contracts are settled prematurely when price oscillates. We have examined the pros and cons of futures trading as well as its applications. Together with Topic 1 and 2, we have completed Chapter 6, Futures Currency Trading. After this, you have attained knowledge about futures such as definition, features and characteristics, deposit and margin, etc. You have practiced this operation to comprehend its daily evaluation basis. You are now able to differentiate it from forwards trading. Ultimately, you can analyze its advantages and disadvantages to tell why it is a favorable speculative tool in FX market. Though it has great benefits, similar to spots, forwards, and swaps, its immutability is an obvious drawback. This can be solved using options currency trading, which will be introduced in next chapter, the last chapter of this course. Thank you and see you then.